Brian, thanks so much for being here with us. You know, we've been talking an awful lot about the cross currents. The coronavirus is still this overhang, but then we also got news overnight that China is cutting in half the tariffs on the U.S. import. So there's a lot here for investors to digest. We also had kind of a surprise outcome in the Iowa caucus. What do you make of all of it? How are you putting it all together as you look at the markets here today?
Well, when I think you look at the markets here, obviously we're moving to all-time highs here, Courtney, and so that's a positive for the stocks, and we've seen great earnings here in the month of January prior, so it looks all positive and rosy, but when you take a deeper dive into it, there's still some underlying concerns. You mentioned coronavirus. You mentioned the election coming up in 2020 and some of the tariff cuts here by China. And I think when investors are looking at that, there's still some nervousness about that because despite the market moving to all-time highs, we're seeing VIX and volatility, a measure of fear, still continue to be a little bit higher than it was to start the year here. And that's a little concerning. Some investors a little bit concerned about this as we've seen interest rates get lower on the 30-year Treasury. That's one thing I'm looking at. Those interest rates being so low, despite the market moving to highs right here, is a little bit worrisome that people are fearful about what's actually happening.
So when you say worrisome, I mean, truly, how worried are you? Are you talking about a tiny pullback? Are you talking about the R word or recession?
Well, I mean, Courtney, the last time we used the R word, right, was 2007 into 2008. And when you look all the way back to there, we are actually seeing some similarities there. So when you look at volatility and fear, right, typically that rises as interest rates rise. Why? Because, well, it becomes more expensive to own a home for interest. Interest rates are rising up and volatility creeps into the marketplace. But when we see the yield curve invert, like we saw in August of this year, like we saw in 2007 and 2008, when we saw that inversion take place, when interest rates go higher, volatility actually comes down, and vice versa. When interest rates go lower, VIX starts to rise. Why? Because people are fearful about what could take place here. The movement from stocks into the bond market starts to get people really nervous about that big R word that you're talking about.
But it is funny because you talked about that yield curve inversion. When it happened, we talked about it an awful lot. There was an awful lot of fear, but nothing happened, at least economically, in a really major sense. So why are you starting to worry more now? Why is the VIX creeping higher now? What's different from, several months ago when we saw that yield curve actually invert?
Well, Courtney, when the yield curve inverts here, recession just doesn't happen overnight. It takes a little bit of time for some of the liquidity in the market from the bond market into the stock market to sort of bleed over and then into the economy. It's sort of a forward-looking thing 12 months or so down the road. So right away, yeah, we're okay. But now, as we're starting to get closer to that 12-month mark or so, now we're starting to see volatility in stocks rise. We saw a flush down in January and all of a sudden rip back up in here in February, and that's really unusual. Stocks should not be moving this fast. The valuation on Google or Microsoft or Apple and some of these big tech names that are growth should not change overnight like we're seeing here.
Right.
Obviously, there's concerns about coronavirus and whatnot and everything like that. But as interest rates start to go lower, that's a movement out of the stock market. It's pulling liquidity from the system of the stock market and concerns about potentially a recession.